Let's get to our closing bell exchange for this Tuesday. David Waddell from Waddell & Associates is with us today. Kenny Polcari from O'Neill Securities is at post 9, and Rick Santelli checks in from the CME in Chicago. Welcome, everybody. So, Kenny, what's it going to take? I mean, you know, it's been the financials that got us here. Maybe it's the financials that need to move us over, and they're lagging today.
Listen, I think if they, exactly right. So if they blow on the financials a little bit, I think we go right to down 20,000 very quickly. But, you know, it feels like today, like it has felt for the past week and a half, we get so close and then we fail, right? We were up at 19,980, I think, earlier today, and then it just failed there again and is pulled back. You can feel it. It's not just ready yet. I think it is going to happen this week, but I think they have to just give a little nudge to the financials, and we'd be at down 20,000 in seconds.
David Waddell, what are your picks here?
Well, I mean, forget Dow 20,000. Let's talk Dow 30,000 by the end of the year. Just trying to talk it up. Just give it the nudge necessary.
Okay.
Yeah, just which year?
Sure, 2,000 points a day, no problem.
Yeah, no problem. So, did it work? I can't see the tape. Anyway,
no.
You know, I think that I hate to be consensus. I prefer to be contrarian, but I think the consensus is right going into next year. I mean, I think it's U.S., I think it's small cap, I think it's cyclicals, I think it's consumer discretionary, I think it's financials. I think a lot of people have gone back and dusted off their playbook from Reagan 1.0, which, by the way, was a pretty fantastic period. And just to allay any dollar concerns, the dollar was up 50% during that period, and yet the S&P was up 50% in that period as well.
But David,
GDP
it's hard
grew.
Yeah, I mean, we've talked about this analogy, you know, almost ad nauseum at this point, but you do have, look at what the inflation back in that period, central bank policy. I mean, you know, from that point of view, it's a little bit hard to compare, at least at this point and very early.
Well, and so let's cut those numbers in half, right, for those concerns you just mentioned. So, I mean, a tax reform is a big deal, and anybody who's bet against Trump so far has lost money. So, assuming that Trump gets his agenda across, which, again, the market believes he can, then there will be some fiscal stimulus to match monetary stimulus. So we're back into kind of a guns and butter kind of era. And my expectation is that the reality does meet the expectations. We just have to get to January 21st to figure out what reality is going to be.
Hey, Rick, you know, yields continue higher. We're all waiting for Dow 20,000, but in the meantime, NASDAQ's gone to 5,500. The S&P is close to an all-time high here. Yields, though, on the 10-year continue to creep higher. As we move into the new year, we've already exceeded expectations for what the yield would be for the end of this year. What do you see happening in the first quarter of next year for the yields on the curve?
Well, I think a lot is going to depend on Trump's 100 days and how the equity markets in general respond. If we continue to build on the rally now, and I know it's fun to do the 20,000 thing, but to me, the main issue is very little give back. And on interest rates, you know, I think a big topic yet for the final few days of the year, and you've talked about it a lot, is, of course, the rebalancing. Right. Until I see the rebalancing in interest rates, see the 10-year start to dip under 2.5, I will hold out hope for 20K this year. But I think as for next year, all the little questions need to be answered. I don't think interest rates are going to give up a lot of ground, but the real issue is what we see at 3 handle. And I think one of the main litmus tests that many traders will look for is something as simple as the repatriation of all the money overseas. If Donald Trump allows it to come back and go into the equity market, that's one thing. If he puts some incentives on it to put the money to work in ways that may expand the economy in other ways, I think that would be good. You know, Kelly just said it was different back then. Comps. I think we forget how market negative and Wall Street negative and bank negative everything has been since the credit crisis. I would not underestimate the power of going the other way. I still think there's a lot of horsepower left, but the first 100 days will decide.
Rick, I'm with you on that, but my point was more about just inflation, right? In the early 1980s, and you know this better than I, you had kind of rampant inflation and a big, deep recession and Volcker at the, you know, Fed doing all the tightening. So I just meant from that point of view, is it comparable? If anything, we feel like we've gone through the opposite here.
Yeah, I don't know. I think there's issues today that make it almost worse, which means that the spring is coiled. Maybe the expansion when the foot comes off is going to be greater. Yeah, we had more inflation, all those issues, but at this point, we've had very little business spending, capital investment, R&D. All the policies have given a helium effect to certain financial assets. I think there's something big here that everybody's just kind of glossing over.
Except the market, like you were saying, David. But Kenny, I was going to ask you, too, about something a little bit more specific, and it's oil prices.
Right.
What kind of impact, I mean, how important is it for oil to hang on to around these $53, $54 marks for the market?
I think it is important for oil to hang out right here. I think most people have oil somewhere between, $45 and $55 really for the year. Not a whole lot of reason to see it really rally much above there because the U.S. producers are going to come back online. The non-OPEC producers at this price are going to come back online. But let me just say one other thing to the point that Rick and Dave made. Don't forget, in the Reagan era, interest rates were 21%, right? 1982, and when I came into this business, and when they started cutting rates is when the market took off. We're at interest rates at sub 1% at the moment, and so therefore you have to, although I agree with you, I think the market's going to do better, I think you have to be careful comparing it to the Reagan era just because the economics were so different.
And David, that's why you've abandoned the defensive stocks at this point because of the expectation the rates are going up, right?
Yeah, I mean, I've been surprised that the move in the 30-year hasn't been as big as the move in the 10-year. So maybe there's a little sort of concern about whether all of this economic growth will happen. But going back to the 80s, because I think it's so relevant. So when the interest rates came down and inflation came down, and it came down with a thud into 1983 after the recession that Kelly mentioned, you saw an expansion in PE multiples because we started off at 9, but then you saw earnings growth really kick in. So that's why I said, okay, cut it in half. So over that first period, S&P was up 50%, right, the first term. Small cap value was up 150%, right? So there are places in the market I think you can go. And I think what's wonderful about the market we're in is we're back in an environment of winners and losers. Fundamentals are back in favor. And so I think there is a right way to play this market, but it's a micro market instead of being the macro market we've been stuck in since 2011.
All right, we got to go at this point, guys. Good stuff, though. Great conversation today. Appreciate it very much.